Every economic crash looks sudden to the crowd, yet wealthy people have been preparing for years before the headlines. Most investors only feel the impact when prices finally collapse, while rich families reposition long before anything looks dangerous. They do not rely on lucky guesses about timing, and they simply follow patterns that have repeated for centuries. During the late stages of every boom, they quietly sell speculation and rotate part of their wealth into sturdier assets. These moves rarely appear on popular social media feeds because they happen while everyone is still celebrating rising markets. If you want to see trouble early, you must watch what the already wealthy are quietly accumulating in the background. Before every major economic downturn, the same five kinds of assets consistently absorb money from banks, families, and institutions. They may look boring during the party phase, yet they become lifeboats when the financial music finally stops playing. By understanding these assets, you cannot avoid all pain, yet you can avoid joining the desperate majority at the bottom. Think of this not as secret billionaire magic, but as a survival map that anyone serious can begin to follow. The first asset rich people buy before crashes is long-term debt issued by strong governments rather than weak corporations. They move into high-quality bonds with distant maturities because these instruments usually rise when interest rates start falling sharply. As economies slow, central banks slash rates to save growth, which makes older, higher-yielding bonds suddenly much more valuable. Wealthy investors position in those bonds while newspapers still talk about soft landings and minor corrections in the business cycle. They study bond markets because yields usually sense danger earlier than stock charts or enthusiastic forecasts from television experts. When rates drop quickly, bond prices climb, and a portion of their portfolio quietly profits while equities around them sink. This is not cowardice, and it is strategy because interest income continues while capital gains appear during the panic. If the feared crash never arrives, those bonds still provide steady cash flow, which the wealthy treat as cheap insurance. Small investors often do the opposite. They dump bonds near the top of the cycle so they can chase momentum. By the time the crowd rushes back towards safety, rich families already own the limited supply of attractive, long-dated debt. They accept slightly lower returns during the last euphoric phase in exchange for powerful protection during the inevitable deflation scare. For them, government bonds are not just boring coupons, they are shock absorbers that pay them while others lose sleep. The second asset appears more complex because it lives inside options contracts and volatility instruments that many people never touch. Wealthy investors allocate a small slice of their capital to structures that gain value when markets move violently downward. They might buy puts on broad indexes or use volatility-linked products, yet the principle behind these trades remains simple. Most of the time, these positions lose small amounts of money, yet they exist to explode upward during rare disasters. The rich view that slow bleed as an insurance premium instead of as a failure or a trading mistake. When panic hits and volatility spikes, those hedges can offset huge losses and even create positive returns during crashes. Hedge funds and family offices budget these protections years in advance because they know downturns are inevitable eventually. Retail traders usually ignore volatility until it dominates every headline, which is exactly when protection becomes painfully expensive. By that stage, it is too late because contracts that were cheap earlier have already multiplied in price beyond reach. The lesson is that rich people do not buy fear while everyone is screaming because they already bought it earlier quietly. They accept a small, predictable cost every month so that one violent quarter does not destroy decades of patient compounding. You may not trade complex derivatives, yet you can learn the mindset, which is to ensure risk before disaster, not after. The third asset is distressed credit, which sounds technical, yet simply means loans or bonds sold in moments of deep fear. Before crashes, wealthy families set up relationships with managers who specialize in buying debt from forced sellers at discounts. These managers watch corporate balance sheets and legal structures so they can distinguish temporary problems from permanent destruction of value. When recessions arrive, banks, hedge funds, and over-leveraged companies must raise cash quickly, and they sell whatever they can. Distress specialists step in at those moments and buy claims on real businesses for a fraction of normal prices. The rich provide capital to those specialists long before the storm because such deals appear only when liquidity suddenly vanishes. Years later, those positions often deliver streams of interest in principle that look like genius, but were simply prepared agreements. This kind of investing is difficult for ordinary savers, yet the principle remains useful for anyone paying attention. Great opportunities rarely appear in comfortable times, and they usually arrive when fear blocks most people from writing any check. Wealthy investors solve that problem in advance by keeping dry powder and by having trusted partners ready to deploy it. They understand that every crash eventually creates bargains in good assets that were temporarily sold alongside genuinely toxic waste. By committing to disciplined, distress strategies, they turn someone else's forced liquidation into their own long-term income and control. The fourth asset is far older than modern finance, and it sits quietly in vault safes and hidden storage locations. That asset is physical gold, which rich families continue to hold despite endless claims that some new system has replaced it. Gold does very little when confidence is high, yet it shines whenever governments respond to trouble with money creation. When central banks push rates below inflation and expand their balance sheets, they quietly tax savers through lost purchasing power. Wealthy people know this pattern from history, so they own metal that cannot be printed or defaulted on by decree. They often hold it in secure jurisdictions or through vehicles that actually own bullion rather than vague paper claims. During long periods of stability, gold may lag behind stocks, however it exists to defend against extreme monetary experiments. When currencies slide and trust in policy breaks down, that dull metal suddenly becomes one of the few unquestioned assets. For ordinary people, gold coins might be a small hedge, while for dynasties it is a permanent core holding. They treat it like an insurance policy on the value of every other currency-based investment on their balance sheet. They do not sell all stocks and bonds for gold, yet they make sure some deep layer of wealth sits in metal. In a world of promises and credit, gold remains the oldest form of money and the least dependent on human honesty. The fifth asset wealthy people accumulate before crises is productive land and essential infrastructure that people cannot live without. They buy farmland, forests, energy assets, and water systems because those resources keep generating value even during long depressions. A good farm produces food every season, regardless of stock market prices, and people continue eating whatever the headlines say. Timber grows quietly year after year while politicians argue and pipelines move fuel, whether indices are rising or collapsing. Rich families prefer owning such underlying assets instead of owning only companies that rent them for short and fragile periods. They know that offices, malls, and luxury projects can empty quickly, while land that feeds and powers populations rarely becomes useless. Sometimes they purchase not just the land, but also businesses that store, transport, and process those essential materials for others. During emergencies, income from crops, energy, and utilities may fluctuate, yet it rarely drops to zero the way speculation can. History shows that families who hold productive earth and hard infrastructure often remain influential long after empires and currencies fail. They may not achieve spectacular gains every year, yet they avoid the complete wipeouts that destroy purely financial fortunes. Owning physical sources of food, energy, and water also grants negotiation power because everyone else still needs those basic services. For that reason, generational wealth often hides not in glamorous skyscrapers, but in quietly held acres, pipes, and reservoirs. When you step back from these examples, a simple pattern connects every asset rich people buy before economic crashes. Each one represents a claim on something real that continues working when speculation freezes and easy credit finally disappears. Long-term bonds respond to falling interest rates and fearful capital, while volatility hedges spike when markets suddenly lose balance. Distressed debt transforms panic selling into future payments. Gold protects against currency manipulation, and land keeps producing essential goods. The average person usually learns these lessons only after being hurt, yet you can learn them now by observation. You do not need billions to copy the framework, you only need discipline and a willingness to think several cycles ahead. Start by asking whether your savings rely entirely on optimism or whether some portion is anchored in assets that survive fear. You may begin with tiny positions, yet the important shift is mental, from chasing excitement to purchasing resilience on purpose. Over time, that shift can mean the difference between watching your net worth vanish or watching crises from a position of strength. If you want more guides that translate the behavior of empires and elites into practical moves for normal investors, stay here. This is Empire and Money, and if you value these hidden patterns, then subscribe and keep learning before the next cycle turns.